We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Keith Weiner, president of the Gold Standard Institute and CEO of Monetary Metals. And also he holds a PhD in economics. How are you today, Keith?
Hey, Tom, how are you?
Excellent. Good to have you back and have your interesting perspective on all things gold and silver and macro here today. So, going through some of your recent work, I came to the idea that you presented of the Sniff Test, and you developed that when you were a software engineer. So how does it apply to gold and silver today?
So we actually had a problem way back in the previous software company that we had a client and server, and every time we would update, of course, we had to update both versions, and there was some code in there that checked to make sure they're a compatible version. Anyway, make a long story short, we sent to a client a new version of the server and the client that had been tested independently, but not one connecting to the other. And when the client tried to set it up, our customer tried to set it up and make the client connect to the server, it came up with the error message, incompatible versions. So as you can imagine, the client was pretty angry. They were on the East Coast. In addition, they were military guys used to getting up at dark 100. We were in Arizona, 3 hours behind them and coming in, rather a bit later. So they had a good part of their day to steam and get angry before I had a chance to chat with them. So after that, I went into the room with the developers and I said, we need a basic sniff test. Something that, can we quickly tell at a glance if this is not good, and then let's not send it. Mm-hmm. And so I thought that's a useful concept. In economics and a lot of things where people say the most outrageous things. Some socialist of the Georgist variety, Henry George, wanted all the real estate to be owned by, the collective. So he declared on Twitter yesterday, and I didn't respond, but he declared that there's only one reason to own a house, and that is for rent control. That is, the rent can't go up if you own a house. I'm like, that doesn't even pass the sniff test. I mean, go out and ask 10 homeowners, why do you own a home? And you're going to get 10 answers that probably none of them are rent control. And so there's just a lot of things like that just people say it, and they say it with a straight face somehow. But if you just give it the basic sniff test, then it doesn't, withstand any scrutiny.
Mm-hmm. So how does that apply to, let's say, gold and silver in this current environment?
I think a lot of people say a lot of things. I'm trying to remember in what context I may have said that about gold and silver, but I'll just take the one that's my favorite pet peeve, which is the people say that these banks are profiting from destroying your long position with their shorts, and they're not-for-profit traders, and therefore they can take unlimited losses and they don't care. And that's one of those things. Well, wait a minute, are they greedy and profit-seeking, and therefore you want to get them with antitrust, or are they not-for-profit because they're subsidized by the Treasury or the Fed? We'll pick one, but not both. To utter both in the same breath doesn't pass the sniff test.
Yeah, it seems very contradictory. So you have an interesting, let's say, term that you developed, and that's explaining the markets through the lens of basis. So how does that apply to the silver market right now, and how does that kind of instruct you where the price is at the moment?
So if I can just take a couple of minutes to try to explain this in an intuitive way. Mm-hmm. Suppose, and I mentioned your latitude, the harvest may be at a different time, but I've been told that the wheat harvest in the U.S. is largely early August. So suppose you drive up to one of those grain elevator towns, in the American breadbasket in the Midwest, the last week of July, in other words, a week or two before the harvest. And you say, and drive up in a grain truck and say, how much to fill this here truck with wheat, a week or two before the harvest comes in. And let's say at that moment in time, you see wheat on the screen, trading at $8 a bushel or something. Well, first they'll laugh at you. I mean, they're probably hosing off the equipment. I don't know if those silos, the dome has a hinge and it pops open, but I sort of picture the daylight shining through there, and they're hosing off all the dust and the spider webs and everything, getting ready to receive the wheat harvest. And but if you take out a wad of $100 bills, somebody will make some phone calls, and there's a truck halfway to a bakery that's going to be paid more to turn around and come back. And for, I don't know, let's say $18, it'll come back in a couple of hours and then offload into your truck if that's what you really want. So you have a situation where wheat for, let's say, September delivery is $8. But if you want to buy it right now, it's $18. And so that is obviously because there's a scarcity right before the harvest. Nobody has any wheat anymore. Wheat is pretty much all consumed right before more production comes in. And the reason is wheat spoils, and you can't just hold that forever. And so there's a scarcity of wheat at that moment. And so if you take a look at that spread of spot is $18 and future delivery basically the next month out is $8, that's inverted. That's a backwardation, is what it's called. That's the technical term. Mm-hmm. And so in financial markets, if you ever see a spread that's persistent and big like that and persistent, that's a signal that you can take a profit by a risk-free profit, by the way, in this case, by taking that trade. And the reason why that persists on your screen, it doesn't go away in a microsecond, is that in order to take this trade, you have to have physical wheat. The only way to take this trade is to sell physical wheat, buy the future to recover your position. You have the same position and a $10 fat spread for doing so. But nobody has any physical wheat 2 weeks before the market because wheat is all consumed down. Now, how does this apply to gold? In gold and also silver to a lesser degree, we've been accumulating this stuff for, so far as we know, 5,000 years. And so there is no such thing as a scarcity or as a shortage per se. Gold isn't really consumed. I mean, you make it into jewelry, you make it into art objects, make it into whatever, but those things can be melted down when they go out of style or whatever, and then recast into bullion bars. One quick trip to the refiner, and a week or two later, you have bullion again. And so there's no such thing as a scarcity or shortage per se in gold, but there can be a shortage of gold to the market. So what does it mean if spot is above futures? It means that people don't trust, because this is deemed to be a risk-free profit in conventional terms, right? All you have to do is you sell your gold bar, get a piece of paper that you're going to get delivery in a month or two, and pocket a profit. If nobody's taking that, it's not because nobody has the gold. Somebody has gold. It's because they're saying, you know what, I'd rather hold that gold close to the vest right now. I don't trust the counterparties. Now, the gold community is full of, oh, this is it. Nobody's going to trust the system anymore. Every time the Fed says something, the Fed's lost credibility. No one's going to trust them. No. Watch the spread in the gold market. When you see a backwardation, that's when the people with the gold are making that determination. And the same thing in silver. Now, this also relates, if gold were somehow manipulated, and I don't mean people talk about the JP Morgan trader got caught spoofing or front running, which is of dubious ethics and dubious legality and all that. The regulators and the courts handle that. I'm talking about if the supposition is that the price ought to be some much larger number, $50,000 an ounce. If you divide some measure of the money supply by, the Treasury's gold holdings or something like that, and you come up with these numbers that people do. It's supposed to be that number, whatever, $65,000 an ounce. But because of some, vast suppression scheme, the price is kept down to a mere $1,800. Well, how would that be done? Well, one of the most common proposals for that is that they would sell futures contracts. So that the theory is that the physical is scarce, and demand is rising, but the futures are dumping unlimited amounts of paper, diluting the paper stocks, and so the price goes down. Well, if you look at the spread, so the basis spread is essentially futures minus spot, and then you quote it as an annual percentage rate, so you can compare it to LIBOR, you can compare it to other yields on T-bills and whatnot. If you have these two things that are pretty close, spot is always, I shouldn't say always, it's normally a little bit lower than futures, and then meanwhile, both of these things ought to be $50,000, but they've sold futures down to 1,800. Well, you'd see this massive backwardation. And the fact that you don't see that massive backwardation, the fact that the opposite condition, which is called contango, exists in the market, means that there isn't that massive naked selling of paper going on. And the basis is, it can't be faked. I mean, if you're suppressing paper, you're suppressing paper. But according to the theory, and also if you look in reality, you can't suppress the physical. The physical is owned by a very large and diverse number of people around the world. Having traveled around the world, I can now say I think we Americans, and I'll include Canadians in this, probably understand gold's least well compared to the rest of the world. And that's because we're in the fortunate position of not having had a regular currency crisis, every 10 or 20 or 30 years, where everybody loses their life savings. The US dollar, the Canadian dollar have been pretty good over the centuries. And so we've learned to trust our paper currency, so people don't really think about gold. But in the rest of the world, everybody either aspires to own some gold or does own some gold, even in very poor countries. And so you have a huge number of people who own gold. Gold is not largely held in the banking system today, not largely by the central banks. It's impossible to suppress. It's far, far too big for that. So that's I guess you can call that's the sniff test. If you're suppressing paper, but not spot, not physical metal, then you'd invert the spread. Mm-hmm. And there's no explanation for how you would not invert the spread and yet suppress.
Yeah, it seems like going back to the beginning of your explanation, there could be a shortage, but it's only a shortage at, let's say, these prices or $1,500 an ounce, right? There's a shortage of people that want to sell for that, considering what they can sell for at the current time, right?
Yeah, that's right. Everybody has their idea of what they think their gold is worth. It does tend to be the case that you see. So the basis is kind of a measure of abundance. The inverse of the basis, which we call the co-basis, which is spot minus future, is our measure of scarcity. As the price goes down, you tend to see abundance falling and scarcity increasing. So there's less and less people that are happy to sell at those prices. But it's a very funny thing. And of course, macro events can be driving people to do things they didn't necessarily want to do. So if they're feeling a squeeze somewhere else in their balance sheet, they may sell gold because gold is the easy thing to sell when all the other assets are likely to go no bid or whatever. Mm-hmm. So you have that going on. And then secondly, people's idea of what gold is worth tends to have some recency bias. So if it's been trading at 1,900 and then it goes to 1,800, then people think, well, it's worth 1,900. I don't want to sell at 1,800. But if it stays at 1,800 for a while, then some people may sort of change their idea of where they think it should trade at. And then if it goes to 1,700, then back to 1,800, you've got a lot of people think, this is my chance to get out before I take any more losses. So all the psychology factors are going on, and the marketplace gets pretty messy.
Mm-hmm. So Keith, if gold and silver aren't going to the moon tomorrow, as we're fairly used to hearing, what is the point of buying metals? What are the right reasons to be entering that trade to trade dollars for the metals?
So that's a very philosophical question, but I think in short, it's important, number one, for people to realize the dollar is a credit. It's not a thing. It's not an object that you can hold. I mean, hold a piece of paper, but what does the piece of paper say? It's like if you have a fur coat and you check it at a fancy hotel coat check closet, the piece of paper that says, your coat serial number 1, 2, 3, 4. That's not the thing. The thing is the coat itself. The dollar is a credit. And it used to be understood until certainly before 1933 that when you deposited money, which meant gold, you had the right to get that deposit back. There wasn't the price of gold. There was, they standardized the amount of gold in the unit. So everyone, if I said I had $10 at this bank and you had $10 at a different bank, we knew that it was the same. It's like if my computer has, whatever, a megabyte and your computer has a megabyte, government isn't dictating how big your memory should be. It's just saying if you have a million of those, actually 1,024,000, whatever, that we all are speaking the same language. So there was a right to get your gold back, and then they defined the unit of account, which was the dollar, and then approximately 20 of them was an ounce. So the dollar's a credit, and then what they've done is mutilated it and mutated it and spindled it and folded it over the centuries by degrees and corrupted it and made it unsound and dishonest. And so I think there's a couple of basic prerequisites for honest credit, honest borrowing, and that is two on the lender side. The lender has to be knowing and willing. In other words, you know that you're lending and you agree. And people who owe dollars, many of them say, well, you have to sell treasury bonds because look at what the US government is doing. But then if you sell your treasury bonds, you have dollar cash. It's out of the frying pan into the fire. You don't even realize you're lending. And then two on the borrower side, which maybe are more germane, which is the borrower has to have the means to repay and the intent. And today the borrower, the primary borrower of the dollar, the US Treasury, clearly lacks means and intent to repay. So, I flipped the question around. What's the reason to go all in on this credit, which the borrower lacks the means and intent to repay? There's something screwy about it. There's something dishonest about it. When somebody does something dishonest, you don't necessarily know when it's going to blow up. I mean, look at what's going on right now with that Chinese property developer. What's the name of it?
Evergrande.
Evergrande. When is that going to blow up exactly? Well, I suppose you'd have to have insider information to know exactly when the blow up is going to be. However, a lot of people could have told you years ago it's unsound, it's screwy, something bad's going to happen. So what's the reason for getting out of Evergrande paper and into something safer? Well, the reason is you don't want to be there when it blows up. It's infinitely better to be out a year early than to try to get out an hour late. Mm-hmm. And you don't know when. It's not fundamentally, it isn't knowable when this is going to occur. So that's my case for why people should own money, which means gold and silver.
So you recently wrote an article about Coinbase having to borrow $2 billion to finance its operations. So can you explain to our listeners the irony here?
Yeah. So Coinbase is a public company. They now access to the bond market, and I saw several headlines crowing that this validates crypto. They're now this leading crypto company is now borrowing all this money to grow and expand. And this really validates crypto. And I'm like, the leading crypto company borrowed dollars. They turned to dollars for their borrowing needs, and this validates crypto. So I think I tweeted and I said, think about it, take as long as you need. Something I've been saying for a long, long time as an economic theory, they've now demonstrated that they agree, and that is crypto cannot be used to finance productive business enterprise. And even the leading crypto company doesn't dare borrow in crypto. Why? Well, Bitcoin's supposed to go to $1 million or whatever. If that's true, and you borrow Bitcoin at $40,000, it's your data is going to go up 25 times. Nobody wants that, so they borrow dollars. But that's kind of a infinite loop. Then the next borrower, even in crypto space, again has the same problem, and the next one has the same problem, and the next one has the same problem. It'll never be suited to borrowing because the volatility means you could be bankrupted if the price goes in the direction you want it to go. That's the other irony. It's not that, let's say you go into the gold mining business, you can be bankrupted if the price of gold were to go to zero tomorrow, obviously, but not if the price of gold goes in the direction you want it to, which is up. Then as a mining company, you're doing pretty well. But in the case of finance, so everyone uses this term finance. Bitcoin is the future of finance. And what they mean is trading. We have these tokens and there's this almost frenetic activity of trading them, and the velocity of trading, goes up and down. And these things are changing hands. At the end of the day, people want to trade them for consumer goods, whether it's food, iPhones, Ferraris, mansions in Malibu, whatever it may be. And all of these things, well, maybe the mansion's already there, but everything else that we're talking about has to be produced. How do the goods get to your local, retailer distributor? That all requires finance, and finance doesn't mean trading tokens. It means investment in the capital or in the inventory, paying the wages and everything else. Because you have to pay the wages up front, then you get the goods, then you get to sell them, and it has to be in that order. These things require finance, and Bitcoin is demonstrably not suited for that function. Now, the problem then for Bitcoin is, if there's no finance in Bitcoin, that means there are no Bitcoin debtor. And when I say Bitcoin debtors, I know that people can borrow Bitcoin for trading purposes and for financial arbitrages, but not for producing food. So all the food producers, meanwhile, are desperate to get their hands on dollars. They make a ferocious, relentless bid on the dollar. That's what keeps the value of the dollar up. It's not some faith-based thing that's just waiting for one pin to go ding. It's that every debtor, which means every productive enterprise, virtually, is in debt, relentlessly, desperately has to produce and dump their products onto the market bid to raise enough cash that net of all their expenses and wages and everything else, they can service their debts. That's what makes this relentless bid on the dollar. And you'll never have that in Bitcoin. Now, what does that mean? Is so people say there are merchants who sell for Bitcoin today. I say not quite. Those merchants hire a third-party currency exchange via an API, and the third-party currency exchange finds a fourth party who wants to buy Bitcoin and has dollars to do so, and then washes the transaction. So the customer wants to buy the flat screen TV, and he wants to pay, 1/40th of a Bitcoin. The vendor has a flat screen TV. He needs to get $1,000 because his cost of goods sold are denominated in dollars, his wages and his rent and everything in dollars. So he says to the third-party currency exchange, give me $1,000 for this thing. I don't care what you do in Bitcoin world. Third-party currency exchange says, fine, we have an API for you. And so there's a guy over here who's got, let's call it $1,100 to buy the Bitcoin. 1,000 goes to the merchant, 100 goes to the currency exchange, and they wash the transaction around. And so everyone says they're using Bitcoin as a medium of exchange, but not really. The merchant needs dollars because their debts are in dollars.
So the title of the piece that you wrote was called Gold 1, Bitcoin 0. So why is it Gold 1? And how are you really trying to bring gold back into the lending system and trying to unlock the productivity of gold?
So so unlocking the productivity of gold is our brand mantra. And actually it would be unlocking the utility of gold, but we thought that utility is maybe sort of too technical in economics term. In 19, shows you where my head is at. In late 2020, we issued the first proper gold bond. Not a bond denominated in dollars with gold as collateral, or a bond denominated in dollars whose payout price went up or down with the gold price in some way, but an actual bond denominated in gold with interest and principal paid in gold. And we did that to finance a gold mine in Australia. Recently, the bond was paid off, and all the investors got back the original gold plus interest. And so the occasion of seeing this news from Coinbase that they had borrowed, I think $1.5 billion, and the amount went up. Really made me think. Here, we've done something in gold. So people say gold and Bitcoin are competing. We've done something in gold that cannot be done in Bitcoin. and that is finance something borrowed in gold, denominated in gold. And actually, it's good for the borrower to not denominate in gold. Obviously, number one, gold doesn't have that crazy upside. It's not going to be $1 million an ounce. I don't think even the most ardent gold bugs would claim $1 million an ounce by next year, the way they do for Bitcoin. But to a mining company, the biggest risk and the one that management has no control over. I mean, everything else, management has some degree of control. I mean, if your workers strike, maybe because you're treating them badly. If you have a collapse or a cave in, maybe that's because you didn't do your engineering properly. But a drop in the gold price, as a management of a gold mining company, is nothing you can do about it. You have no influence over that. So what borrowing in gold does is it matches, the gold mine knows they're going to pull this many ounces of gold out of the ground. And now if you're borrowing in gold, you've matched your liability to your income stream, and you've taken out risk that otherwise that they would have to hedge some way, or they would have to accept the unhedged exposure. And then as the price goes down, obviously you get hurt. So it's a win-win transaction. It finances a productive enterprise. And for the investors that are holding gold, it's pretty compelling why you'd rather get paid interest than pay to store it. And so it's just a win-win transaction all around, but it proves gold can be used for finance. If we can do it once, we'll do it again. If we can do it again, this is something that's really going to scale. And so we're bringing gold back into the financial system by creating this new capital market, which is the gold bond market.
So theoretically, isn't the miner, the one taking the gold loan, are they not exchanging that for Australian dollars? Is it not just being used as another medium of exchange, or is the plus of it just that it's so much more stable?
So yes, obviously, they sell the gold in order to pay for payroll and diesel fuel and equipment and all those things. But what's notable about this is that the amount of debt is fixed in ounces, not in dollars. So yeah, you sell the gold, and at the time we did the loan, I'm trying to remember, it was worth X Australian dollars at that moment in time. But the value of the debt wasn't X Australian dollars, it was X ounces of gold. And that is what they owed the repayment of. So to the investor, if you invested 10 ounces in that bond, you were owed 10 ounces plus interest on return. And of course, the gold mining company produces gold, so it's not like they have to go into the market and chase the price to repay. They can deliver the gold into the loan obligation.
As we think about the repayment in ounces of gold, is this really only beneficial to have that type of bond issued for gold miners?
No, and that's also very interesting. So we're working on a number of bonds, more gold mine bonds for sure, but also some bonds for non-gold mine related companies. And something I'll just put on the table for now. When Monetary Metals is ready to raise capital for our own working capital and growth purposes, debt capital that is, it'll be denominated in gold and not in dollars. And we're definitely not a gold mining company.
So, Keith, the last time we had you on the show, we talked about inflation, and you shared with us your idea of useless ingredients adding to the cost of goods. So, has your view of inflation changed, and where has it headed since we last spoke about it?
So, I just put out an article last night talking about this very topic, and in brief, boy, have the useless ingredient chickens come home to roost. So I was looking at the UK and the shortage of natural gas, and how this is really going to start impacting food production. Because first of all, fertilizer plants, apparently, and I don't know a lot about this, but there's a process by which they use natural gas to manufacture fertilizer. And the natural gas prices have gone so high that the fertilizer plants are shut down. And so that's going to be a real problem. And actually, it's kind of interesting. A lot of times you get to Keynesians or the socialists that just almost gloating and they say, well, everything's worked so far. Who are you to say there's doom and gloom? Well, this is the concept of leads and lags, isn't it? That if you destroy the natural gas market and therefore destroy the fertilizer market and therefore destroy the farmers, you don't starve today. It takes a year.
Mhm.
Everything's fine right now. All the food that we're going to eat in the next several months has already been grown. But in the future, watch out. And then in the monetary system, the lags can be much longer than 1 year. That can be decades.
Mhm.
But anyways, in addition to fertilizer, the byproduct of manufacturing fertilizer is pure CO2. So CO2 is used in meat packing, and it's used in shipping frozen foods, in dry ice. So now you're gonna impact the food supply chain from the farmers to the meat packers to the shippers and distributors are all going to get hit by the same problem. Now, what's the issue here? Did the Bank of England print so many pounds that it drove up the price of natural gas and food? Is the purchasing power of the pound any less than it was? And my argument is no. This is the regulators. So the regulators, number one, banned fracking in the UK, and I think that goes back to 2015 or 2017. Banned hydrofracking. So that's one of those feel-good measures. Everybody gets to declare victory against, the climate monster. But for an island, like that, it's kind of dangerous to start to say, well, we're just going to rely on imports. And then you get into the Brexit situation. You get into the situation with Putin and China. There's a lot of geopolitics going on. Being dependent to import all of your natural gas is perhaps not a good position to be in. In addition to that, they're also passing laws forcing electric utility plants and heavy industrial users to switch from coal and oil to gas. So on the one hand, they stop their gas production domestically, and two, they force their coal and oil consumers to become gas consumers. So this compounds the problem. Then you get to the current geopolitics, you get to the rise of nationalism, where governments have the luxury of forcing their domestic producers or just the supply chain managers, and a lot of companies taking their own initiative are trying to secure local supplies, and so they're taking some of the supplies off the market that might otherwise have been available to ship to the UK. So the net result of all this, and then the final disturbance that adds to the perfect storm is the COVID lockdown whiplash, I call it. First, everything stops, and then a lot of pent-up demand is released all at once, and then everybody's, in the global logistics industry is struggling to try to deal with, a year of, demand, all at once. And so shipping, logistics, everything is all messed up. And wait times go from 3 days to 3 weeks or longer. Into all of that, the UK is suddenly saying, hey, we need to import more natural gas. And it just becomes an intractable problem. So people say this is inflation. Inflation is everywhere and always a monetary phenomenon. That was Milton Friedman. And I look at this whole situation and say, none of this is really monetary. That, they've imposed useless ingredients. So the first useless ingredient here is if you're a oil consumer, to force you to substitute natural gas. Well, the difference between the cost of the oil and the cost of the gas is a pretty obvious useless ingredient. But on top of it, they forced everybody to pile into this risk. And adding the risk to the equation is also a useless ingredient. Ask any insurance company if risk has a price, and the obvious answer is it does. Mm-hmm. So they've added all these costs. Now that risk, they rolled the dice and it came up snake eyes. So the risk came in, turned true. And, now they're trying to subsidize various things and whatever, but you can't fix The fundamental problem is you don't have enough nat gas. They can't, the regulators and the subsidizers and the socialists can't create more nat gas. All they can do is shift the problem and say, well, we're going to give the fertilizer industry a subsidy. So that means the fertilizer industry, who had been the marginal consumer of nat gas, will now outbid the next marginal user who's now going to come up short. And then there's going to be a crisis over there. And then those people are going to clamor for a subsidy. And then everyone's going to say this is inflation. Not really, not as conventionally understood. Mm-hmm. And the solution, even with the same quantity of money, the solution is relax the fracking restrictions and let the global logistics industry sort itself out. And then things will come back to normal. Unfortunately, probably not in time for whatever crisis is coming to the UK now. These things will take time. Everything I read about the global logistics mess, it's gonna, if it's solved, quickly, it would be sometime in mid to late 2022. Otherwise, it may be resolved more like 2023. Anybody waiting on that for their food delivery, is in a world of hurt. And of course, the price of food is going to skyrocket. Mm-hmm. It has to go high enough that the marginal eater is going to be deprived of food. How expensive does it have to get before the marginal consumer doesn't eat? I don't know. I don't want to find out, and I think that's a bad place.
Mm-hmm. So, as Rafi Farber recently pointed out on the show, that if prices of everything are going up, there's more than likely a problem with the underlying currency rather than the goods and the supply chain. So how do you see the health of the currencies around the world, and what are some of the symptoms of the sickness within them?
So, I'm not sure the price of everything is going up. But that aside, I don't see the problem as one of simple dilution. In other words, double the quantity of money, therefore it's twice as many dollars chasing the same goods, and therefore prices go up. I think, leaving aside all what I call lockdown whiplash and all the just ever rising regulation, the problem with the currency is that it's unsound and getting unsounder. Every day that they get away with the previous dishonesties that they've attempted, then somebody, it's usually somebody on the fringe of their movement, proposes the next even more brazen thing. And I'm sure you've seen the articles about let's just stamp $1 trillion coin. Take an ounce of platinum or kilo, doesn't really matter. An ounce of platinum is what, $900 roughly, and stamp that into $1 trillion coin. And so that'll be the solution for Congress, who can't increase the debt limit. Hey, we're not increasing the debt limit. We're paying back the debt. Here's $1 trillion to repay it times as many coins as we choose to stamp out. There's a brazen dishonesty about that. There's no standard, but whatever we can get away with, and we can get away with it. So it's all good, going on here. Now, what's the consequences of that? Well, not necessarily prices rising immediately. The obvious consequence is that if there's rotten, dirty, nasty, rotten, tricky behavior at the top, does that not encourage everybody, below them in the system to think, well, why shouldn't I get away with dirty, nasty, rotten, tricky behaviors myself? And what are the consequences of that? And how long is the lag time before we feel that? So that's one set of problems. The other is that when there's borrowing without means to repay, eventually there's a default. So we're moving perhaps in a jerky, inconsistent, not a smooth pace towards inevitable moment of currency collapse. But that's still years off, and maybe a decade or more in the US dollar. I think other currencies are probably much closer. What are the consequences of knowing you're getting close to that? And so it's not a linear process where every day the increase in quantity, prices go up. I think a good analogy I remember reading many years ago, one of the hedge fund managers or somebody was talking about this, was stick-slip dynamics. So you have a pile of sand that's maybe slightly wet, and then you have a little tube at the top, and you're dripping grain by grain slightly wet sand onto this pile of slightly wet sand. And what happens is each grain hits the top and it sticks. And you're building up this pile and it sticks and it sticks and it sticks until suddenly, catastrophically, it unsticks, it slips. And predicting when that happens and predicting how big the whoosh is, like sometimes you can get 10 or 20 grains just topple off the top and then it stops.
Mm-hmm.
And then there's other moments when the entire pile will collapse. And, apparently I'm not into software anymore, really. And even when I wasn't studying this kind of problem. But computationally trying to calculate what that collapse, what that whoosh is going to look like, I think eludes the best computers even nowadays. Like that becomes so mathematically complicated that it's beyond computable at the moment. Mm-hmm. And maybe forever, I don't know. So, we have a monetary system that's headed towards something like that. Each little dishonest act, each little bit of what we call borrowing without means or intent to repay, the debt is growing exponentially. That's pretty clear. Where's the limit? And what are the sticky, slippy things along the way, the jaggies along the way as you approach that limit? 1 minute people will gyrate and say, now I have to own gold because I don't want to own that, a grain in that pile of debt. And the next minute people are selling their gold because they themselves are debtors. And the more you owe and the more unstable the system, the bigger the cash buffer you need. So I wrote an article years ago called an increase in the debt, something like an increase in the debt drives demand for more dollars. Or, the increase in the quantity of dollars, which is debt, drives demand for dollars because all the debtors have to hold a bigger and bigger buffer. If you don't owe any money, how many dollars do you have to have in reserve versus illiquid assets? Not a lot. Mm-hmm. If you owe $1 million, 2008 proved you can't necessarily go and refi that $1 million, when you want. So you need to have enough to make debt service on everything for here and let the central bank stabilize everything. So predicting the exact dynamic and the exact path as the system degrades, there'll be a final moment of repudiation. And that's when gold withdraws its bid on the dollar. But until then, it's very difficult to predict these things. Very nonlinear and very sudden, subject to long periods of time without any seeming change. And then very short periods of time with almost catastrophic changes going on. Mm-hmm. In very nonlinear sorts of ways.
So as you're mentioning, gold taking away its bid on the dollar, how should gold investors kind of change their thinking around, measuring the price of gold in dollars rather to say that gold is worth, the dollar is worth 17 milligrams of gold, let's say? How does that give us a different perspective?
So, let me start with my analogy my flat out statement. And I'll die on this hill if necessary. That it's gold withdrawing its bid on the dollar, not gold going no offer, as most people look at it. And in times of crisis, it's always the bid that's withdrawn. So I like to use the example. Suppose the U.S. Geological Survey, and this is fiction. This is not true. Anybody tuning in right now, do not think this disaster is about to happen. I don't want to be H.G. Wells here. But suppose the USGS were to declare that there's about to be sometime in the next 6 months an earthquake in California, 15 on the Richter scale. Nothing taller than a dollhouse will be left standing. What you would see is no bid on real estate, probably from Santiago, Chile, all the way up to British Columbia and beyond, and maybe as far east as the Mississippi River. You'd see no bid. Everybody is just waiting for the event, and the bid will come back into the market after the event, and people will see what they want to bid on at that point, if anything. But there'll be no lack of offers to sell real estate. So you'll have people that will think they can bargain with the market. Well, my Malibu house is worth $2 million, but I'll offer it. I'll set an offer price of $1 million. Good luck with that, but there won't be any bids. So it's a bid that goes away in crisis. Now, gold would seem to be, and I saw a pretty famous macroeconomist at a pretty big alternative investment conference give a keynote talking about this. That gold is unique, he said, because gold, it's the withdrawal of the offer to sell. I thought, no. This is like, they thought that when everybody believed that the planets orbited the Earth and the sun orbited the Earth, you're trying to interpret the so-called retrograde motion. If you look at Mercury, you see it goes forward and then back, and then forward some more and then back. And you're trying to explain this weird anomaly. The anomaly is actually an artifact of your wrongful, theory. So what's actually correct is think of gold as money and the dollar as credit, and gold bids on the dollar. So inverted around, everyone says, well, gold $1,800, rather than that the dollar is, 18 milligrams. When you do that, a lot of things become much simpler. So I like to use the analogy of, suppose you're on the deck of a ship, which is A, sinking slowly, and B, tossing around in high seas. And from the deck of that ship, you're looking up at a lighthouse, which is obviously on land. And you say, why is the lighthouse going up and down? Mostly up. Why is the lighthouse volatile and rising? Is the lighthouse really rising? And so your perspective is, you're at the wrong point of view. You're looking from the wrong place at the other thing. So I also like to use the analogy, what if you had a bunch of rubber bands and you took out a steel meter stick? And then you take your rubber bands to a certain level of stretch and you say, well, my meter stick is 14 rubber bands long. And you come back tomorrow and then you different rubber bands, or you stretch them differently, and you say the meter got longer. It's now 15 rubber bands long. Is that really quite right? And then now suppose you had a meter stick that changed length as you went up in altitude. So imagine the problems for the engineering and construction industry if by the time you got to the 50th story of a tall building, a meter was about this long. You wouldn't, everybody would try to talk in terms of height adjusted or story adjusted meters, and then try to do their math that way. But I don't think you'd be able to build a very tall building. I think it would all come crumbling down. And these are some of the problems that we have by trying to use the dollar as if it's a great medium of exchange, virtually friction free. But trying to use the dollar as a unit of measure of economic value, you have all these problems. And so I think what people should do is get into the discipline. If you keep a spreadsheet of your net worth, I imagine most people do, every month when you tally it all up, do yourself a favor, get the current price of gold as of that moment, divide the dollar value of your net worth by the gold price, and you see how much you're worth in gold ounces. Then a year later, if you've taken risk and you've worked hard and you've had your stresses and your sleepless nights and everything else, and you go to bed exhausted sometimes, and you have more dollars, but you have less gold ounces, you've actually gone down in net worth. And conversely, if you've gone up in gold ounces, you've increased in net worth. So it's a matter of changing the perspective. Think in terms of ounces rather than in terms of dollars.
Mm-hmm. I like this idea of changing perspective, Keith. And you do a lot of thinking about, let's say, taxes, and the idea of taxing the rich is very popular at the moment. So is this another example of thinking about the wrong solution to a problem and creating more unintended consequences?
Our policy is just rife with, so let's see, we divide all the businesses into two categories, essential and non-essential. And then by law, we shut down the non-essential. Well, that has long-term Orwellian consequences, as the government has that power. But anyways, all the non-essential businesses are shut, and all the employees of the non-essential businesses laid off or furloughed. So then we say, well, no worries, we'll just give you free money. Well, what are the unintended consequences of that? Well, we've now destroyed supply and increased demand. And so now, and this problem still persists in the US. I don't know how it is in other places where there's a lot of people. So there's a trucking shortage. So there's a further problem in the global logistics chain. It's one thing that you can't even get the ship to offload in the port at LA. But even if you can get a berth there, there's a shortage of truckers to carry it somewhere else. A lot of the truckers have found it more profitable, or certainly easier and less stressful, to sit at home and collect whatever check they're getting than to go to work. So what's going to be how's the government going to respond to this? Are they going to say, well, let's end all these welfare programs, and then everyone's going to want to get back to work? No, they're going to pass the next law that tries to force whatever outcome they think they're going to get without really thinking through, well, what is that going to lead to? And so on and so on and so on. It's a never-ending, cycle.
Mm-hmm. Yeah, and kind of going back to the idea of who's essential and who's non-essential, it kind of depends on how many lobbyists you have in Washington to decide if you're essential or not, right?
That's right. Years ago, in my previous business, we were making stuff for telecoms. I was invited to speak at telecom conferences every once in a while. I remember I had a slide in my deck, and it was showing these two sides. They're both dressed in suits, if I recall. But they're basically playing this elaborate war game of capture the flag. And so I labeled the flag the public interest. And everybody who's lobbying the government is always trying to brand itself as we're the public interest. Subsidies for us are good. Actually, you're not subsidizing us because we're selfish, greedy little bastards. No. You're subsidizing us because we're actually good for the public. And so whoever can capture that enjoys those subsidies for the moment. And then the public turns. The mood is fickle. So for a while, Elon Musk could do no wrong because he was building the zero carbon future. Now that he's a billionaire and flying into space, he's one of the prominent targets of this tax the rich, envy, movement. And then who's now capturing the public interest, the public mood, just keeps shifting around, and the government just keeps trying to take everybody's money, rob all the cheaters to pay whichever Paul manages to hold that flag for a while, saying I'm the public interest. Subsidize me.
Mm-hmm. Excellent, Keith. Well, we've had a pretty interesting, wide-ranging conversation here. Is there anything else you'd like to add before we wrap up?
There's so much to say about macro and gold and all these other things, but I think it'd be good to leave it there.
Excellent. Of course, your Twitter feed is excellent. You publish a lot of very thought-provoking ideas on there at KWeiner01, and more of your research articles and stuff like that are all posted on monetary-metals.com. Keith, thanks so much for your time today.
Thanks, Tom, for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.